What's going on, guys? Brian's here. Today is Thursday, November 11th, 2021, and the market is closed. Now, we're not going to be reviewing price action from today. We're actually going to take a look at last week's price action following the FOMC announcement. Now, the FOMC announcement takes place 8 times a year. You can look up the schedule online. Traders always know in advance whenever the catalyst is coming, so you can always plan out a really good trade as well as be prepared for if things go wrong. And that's really what this video is about today. Now, for those of you in the premium Discord, a few of you took this trade with me and we opened up the put calendar spread on the Tuesday. So this was the day before the announcement and we were expecting some sort of a pullback. Now, the reason I suggested we use some sort of a put calendar spread is because if price did not move at this time, the SPY was trading at 461. If the SPY did not move, at least we would not have been taking a loss because the trade actually had a positive theta, which means we actually didn't need the SPY to move in any direction to make money. So calendar spreads is one way to do that. Most people know of iron condors if they're neutral on the underlying. So let's just say you don't think the market is going to go anywhere, you open up some sort of an iron condor. That's not what this video is about, and it's not what I'm suggesting you do around an FOMC announcement or any type of big catalyst for that matter. The calendar spread allows you to be directional because you can structure it in a way that you'll actually be profitable if the market pulls back, but you just don't need the market to necessarily move in order to be profitable. So if we jump here to the gold chat at the time, this was the 3rd. So I was actually not going to be at my desk at the time, so I just typed out a message trying to present some sort of a game plan for everyone, letting everybody know this was again the Tuesday. This was the point of control for that Tuesday, which means it was the VPOC for the following day. It was touched at the open and it was touched right here, and it was acting as resistance all day, right going into the FOMC announcement, which was scheduled to take place at 2 p.m. So this was about an hour and a half or so before the announcement actually took place. And I said, if this VPOC was to break, then you guys essentially can look for a long trade. And if we stayed below it, then more than likely we were going to pull back. So if we take a look at what strikes we were targeting, we were looking at the 458 as our strike price for this put calendar. And if we look at 458 was essentially all the way down here because that was a virgin point of control. If the market was going to pull back, it was more than likely going to be some sort of a deep pullback. So we wanted to give ourselves a little bit of room. So we come back here again and we look 458. So let's jump back to the charts. Let's draw this on the chart right now, and let's go to this VPOC which we're talking about right here. So let's change this. If you guys, if this is the first time what you're seeing, that link is in the description below explaining points of controls as well as virgin points of controls and volume profile. So let's just leave that up right there. So here we go. Ignore the price action that came after. We had this as the VPOC. Market could not hold over it because it makes sense. This is a lot of bears slowly piling into a position, because usually whenever there's any kind of FOMC announcement, the market tends to pull back before going higher, and bears tend to know this, and big investors don't like to start piling into new positions, especially if we're at all-time highs. I mean, if we zoom out for a second, you guys got to remember this is where the market was, so we're already pretty extended past the previous all-time high, and the market was still pretty strong. So as large investors, you're not really going to be super excited about putting on big positions going into something that no one can predict what the Feds was going to say. So if we jump here, we can see during the whole morning, it was an opportunity for big money to essentially start scaling out, start taking risk off in case the Fed was going to be hawkish. Whenever the Fed is hawkish, it means they're expecting some sort of decline in the economy or whatever it is. So whenever you hear dovish means pretty much they're bullish, and hawkish means they're bearish. So bears attack down. That's why bear market means the market is going down. Bulls attack up, which is the animals themselves. Bears swipe their paws down. Bulls swipe their horns up. Doves fly up and hawks attack by flying down. So that's what dovish and hawkish means. And going into a Fed catalyst like this, we don't know if the Fed are going to be hawkish or dovish. But the one thing we do know is that most people are going to be unsure as to what's going to happen. If we take a look at the candles with the colors on, so in case that's making you uncomfortable, I know you guys are used to seeing candlesticks. If we look at this here, if you have a lot of money, and we're talking about, let's just say you are a multi-millionaire, you're a billionaire or something like that, would you really want to be putting more money into this market when you know there's this catalyst coming up, or would you rather just wait? Now, on the other end, bears know this, and they're expecting the market to pull back because the market does not like uncertainty. That's what makes the market drop a lot of the time, or that's what makes sideways consolidation action. There's a lot of money on the sidelines that would just rather wait to see what the news is going to be. On the other end, this allows a lot of contrarian traders, which are people that like to trade against the trend or people that like to trade reversion to the mean. They're looking at the market and saying it's way overextended. It's probably going to pull back. So this means there's a lot of bears piling into this here. There's a lot of short sellers coming in. And when short sellers need to close their positions, there's usually going to be some sort of squeeze because they have to buy back all the shares that they're short. So if we jump back to the Discord and we take a look at what was going on at the time, we were also below the 2-day anchored VWAP, which from a bear, it means the risk is really low from you, because it means you can keep piling into your short and just put a stop loss over here or put a stop loss over the previous high a day. And if you're right, you're targeting like a 3-point drop or something like that, depending on your size, right? Risking 1 point to essentially get 3 points. I'm just averaging things out because it's not necessarily about the exact nuances. It's about the overall general idea. Now for you guys, I ended up mentioning here, I said right now, anyone in the put spread should be just about break even. So we've lost no money holding the option since yesterday. We entered this put spread around here or so, and we're talking about almost a whole 24 hours later, and we're still break even to slightly green on the trade. And that's why I like to structure these types of trades, because if we just bought puts right here, we would have had so much time to eat away at our premium, and we would have ended up probably closing the trade, or it would have put us in a psychological state in which we would have probably been annoyed or just kind of impatient, saying like, why won't the market just drop already? And that's what a lot of other bears are thinking. But options allow you to trade smart or intelligently, or it allows you to get pretty creative. So what can you do to hedge your position without burning up too much capital going into a catalyst like this? That's where deep out the money options come into play, and they serve a really powerful purpose, because we can ultimately see what ended up happening. Obviously the news came out, market broke over the virgin point of control from the previous day, and it just skyrocketed. We ended up flying and hitting 470, which was the new all-time high. Now for members of the Quant Trading app, so in case you didn't know, I'm the lead developer of Quant Trading app. Link is in the description down below. If you're interested in learning a little bit more about the Quant Trading app, that's what you could actually get access to through the Discord. We'll jump over to the Quant Trading app website for a second and actually pull up the chart from the app itself, or from the algo, and we can jump back to last week and see the levels that the algo had generated. And every week we have these levels, we get them straight from the algo, it plots it on our thinkorswim chart, or we can go back here and check it for historical purposes in the archive charts, right? This was the FOMC announcement, and we know what 2 sigma means. We also know that whenever the market is consolidating like this over the weekly sell zone, we usually expect some sort of huge move going into the end of the week, because the market is not supposed to be up here. So this was the first squeeze that happened. We can see the extreme volume that came in. All the shorts that were in this for the past 24, 30 something hours, because they essentially had been scaling in from early into the day. They're considering this to be a pretty low risk short. So they're just going to keep scaling in, just keep shorting the pops. The moment this came out and market cracks, they have to start covering. So the market ends up squeezing, and we go past a level in which the algos are not necessarily prepared for the market to be at. So we ended up getting this squeeze to what's called 2 sigma. So 470 was already a level we knew. We get these levels, by the way, from Sundays. So before price action gets there, we're already aware of where the market could go given certain circumstances. So the strike prices in which we're going to be looking at for out the money call options will be the 465 as well as the 470, because this is a very realistic target following a squeeze like this. And if that squeeze was to happen and the market stayed above 465, we know the next squeeze would put the market right at 470. So we jump back to the chart here. Let's go to the smaller time frame, and actually let's jump over to the options itself. So on the left hand side would be price action, and on the right hand side we have the 465 call option for the weekly strike price. So this was the option that expired last week Friday. Here was the Wednesday, here was the Friday, and we already know 465 was our target, and we would have gotten this level straight from the algo. If you don't use Quant Trading app and you're not a member of Quant Trading app, don't worry. You can use, any type of other system that you use for your profit targets. It could be Fibonacci's. It could be maybe you had a trend line. Maybe you just like the whole number of 465, or it was halfway to 470, or maybe you just had a gut feeling that the market was going to go to 470. I'm going to leave that out of the rest of this video because everyone has their own different way of trading. I like to use a quantitative approach to trading, and I like to know what's very possible for the market to go to certain places, so that way I know what's probable and what's likely versus just guessing where it's going to go. So if we look right here, this was the Tuesday. We're talking about this option following right before the announcement was going for 65 cents. If we jump back to our spread and we see how much did it cost us at the time, this put calendar spread. If this is the first time you've seen put calendar spreads, link is also in the description explaining calendar spreads and why I highly suggest you guys get familiar with them. I think it's one of the best ways to build up an account, especially if you're trading with a small account. You can do this on Robinhood as long as you have a margin account. You can open up $1,000 margin account and use calendar spreads on the SPY, because as you can see, this only costed 34 cents to open. The max profit was $173, and this is a spread we're talking about from a Tuesday to a Friday, so you don't even have to be in it that long. And if the market did not go anywhere, as we already mentioned, it's still going to put you up almost 100%, because the profit on this spread would have been about $50, even if the market didn't really even move for the rest of the week. And calendar spreads, because the Vega is positive, it means if the VIX or the implied volatility increases, your profitability also increases. So the one thing we know going into Catalyst is that implied volatility is going to increase. If implied volatility is the one thing that we know is going to happen, wouldn't you want to open up an options trade that's going to profit off of implied volatility increasing? Now, to my knowledge, most options-based traders, myself included, before I started trading a lot of spreads, I didn't know this, so I didn't think about this. Now I look at the VIX more than ever because I want to know, where is the VIX? Now I love looking at the VIX. I'm always thinking about implied volatility because I want to know, where is the VIX in relation to where it's been historically. And today, say for example, we had a spike in the VIX, so I already know being short Vega is a good strategy to have going into the next day and things like that. But if you're not monitoring the VIX whenever you're trading options, you're doing yourself a major disservice. Jumping back to the SPY, let's just jump back to this chart here. So let's get to the logistics and the numbers of things. If this spread is going for 34 cents, assuming we get, call it 3 of them. So we're talking about $100 position size, right? With a chance to make 3 times this. So 100, we'll call it 150 times 3. That means that's $450. So you're risking $100 to make $450. And that's if you hold till Friday and you just let the whole spread expire worthless. That already inherently has a good risk reward, and your room for profitability is all the way from 452 on the SPY to as high as 463. Now, what did we say? 465 was a possible level for the SPY to go. So if we have $100 in this spread and we're looking at a call option that's going for $65, imagine buying one of these, because you're telling yourself, hey, if the market did squeeze, because there's so many bears that have been piling into this expecting a pullback, we have a good strike selection on our calendar spread because we know there's a point of control down here, and that's more than likely where the market would have sold off to, because that would have only been, let's see, from a percentual basis, from here to here, that would have been a 0.75% pullback. All the way down here would have been about a 1% pullback, which is 456. If we go back to our spread, 452 is our room for profitability, so we can go all the way down to 452, which is currently not even on this chart. Let's just pull this back. So all the way down to 462 is our room for profitability. So a 2% pullback is within our profit zone. Not to mention that if the market did pull back 2%, the VIX would have also spiked, which means our room for profitability would have actually increased. So we would have actually made more money if the SPY pulled all the way down to here. This would have probably pushed our profitability up a little bit, and we still would have ended up making $50. And remember, the cost of this spread was only 34, so that's almost 100% return right there. And if we're in 3 of those, you're talking about making $150 if the SPY pulled all the way back to here. If the SPY hit our strike price and kind of hovered around there, we'd be up a huge amount when you talk about just a percentual return. And if the market didn't go anywhere, we'd still be up almost 100%, right? So now you start telling yourself, hey, if the market was to go in the opposite direction now, how much would I lose or how much would I make? Obviously, if you hold till expiration, you would lose the entire spread. So let's just say you want to risk the whole $100. If you come here and you say like, hey, I'll buy this option, it's only going to cost 65 cents. I'll just get one of these because I'm in 3 of the put calendar spread. Now you're talking about this $65, market squeezes, and where does it go to? First profit target 465. Within the same day, you're up 120%, which would be $80. This one contract alone on the same day already makes you green overall, even though we were targeting a pullback, and it didn't have to cost you too much money to essentially hedge the spread. And at the time, as the market would have pushed, you actually would not have even been down how much you would have been up. So we would be up $80 on this, but the spread would not have been down $80 yet. Remember, you would have put $100 into that calendar spread. That spread is not going to lose 80% of its value on a move like this on the same day that expires on a Friday. So there's no way to go back to see, unless I went on demand to see exactly how much the calendar would have been down. But let's just say for educational purposes that calendar spread would have went from $100 to we'll say $60 is what it probably would have been. So you would be down $40 here, but you would be up $80 here. So that would put you up overall $40, right? So now we're talking about having a cash flow of plus $40, and our total investment is $100 for the calendar and 65 cents. So we have $165 in calls and puts, but now we're up $40, right? $40 on a $165 investment right off the back is already almost a 25% return on your investment if you just talk about it as a return on your capital. So invested 165 to be in calls and puts, and you're already up 25% being wrong on your direction. If the market did pull back, obviously this call would have been crushed, but we already know what's our room for profitability. We're either going to make anywhere from $450 to, let's just say, $300. Any which way you slice it, you're going to be up more on this spread than you will be down buying this call, because even if you held this to zero, you're only going to lose $65 from buying that one call. Now, this is something that takes a little bit of practice as well as a little bit of creative thinking, but after a while, you just start spotting these sorts of opportunities, especially if you're trading options and you're using spreads. You start asking yourself these types of questions, and you can use certain tools like Option Strat, which is something that I love. You can come here and you can start structuring your trades and say like, hey, if I think the SPX is going to go to 4,700 by next week, and this is going to be where if it went past this level, I'm going to start losing money. You start asking yourself, hey, what happens if I buy the 4,750 strike price for the call? So let's just say if I was to buy that call right here, and then you say like, hey, how much is that call going for? Oh, only $1.58. And let's just remove this here, and now we're talking about how much does this cost? Okay, $380, but the chance for, but my max profit on this is pretty high. So if the market ends up landing somewhere around here, I'm going to end up being up $500. If I take a loss on this call, overall I'm going to be up over $300, call it $350. Even if you take a loss on the call that you purchase here, you're giving yourself a lot of room, and you're setting yourself up in a scenario that you have options and you have decisions to make along the way, but they're not scalps. These are situations that you can sit back, you can think, you can formulate a strategy, you can come up with a plan. You can also adjust to see what date you'll be up by how much. So if the market went to 4,700, you'll actually be up in this particular case almost $200. And then if you also had that call that we were just talking about right here, how much would you be up by this point? You'd be up $500. You know, there's different ways to analyze your trade. I'm going to do a dedicated video just on Option Strat and compare it with the Thinkorswim Option Analyze Risk Profile tab. It's another tool that I use. I go there when I'm looking to structure out a really big play. If I'm using, call it $30,000, $40,000 in iron condors, and I really need to analyze my risk. But if you're not analyzing your risk, or you're not using some sort of tool like this, you're really missing out, and you're doing yourself a major disservice as an options trader. So now let's just jump back to looking at how this played out. Obviously, we can see the market ended up hitting 2 sigma. And again, 2 sigma is straight from the Quant Trading app. So if we go back to the site here and we take a look, 470, sorry, not 270, 470. So again, this was our target first one, and this is our second target. This is pretty much the moon. At this point, you can, if it's first time hearing 2 sigma is what we would consider the moon. So now we're talking about by Friday, the SPY hits 470. Your option is now up 714%. So you're up $465. At this point, you don't even have to think about your put calendar for down here that you lost $100 on, because that's how much you invested. If you're up $465, you're up net $360. $5. And that's the type of situation you want to be in. So $365 for your total investment was only $165. You've pretty much 3x your money, and you gave yourself a chance to be profitable if the market was to close anywhere around here, if the market closed anywhere down here, if the market closed anywhere past here is where you're pretty much just multiplying your initial investment. You guys see how being able to analyze all different scenarios and circumstances is one of the beautiful things I think about options trading. I spend more time analyzing and thinking about scenarios like this, and I tend to sit back and wait for when I see opportunities like this, because a lot of other trading is reliant on technical analysis. And as I make my transition to be more of a quantitative trader, I want to take more trades and put myself in more situations that there's almost no real way I can end up losing money. At worst, I might break even, or if there's the black swan event. Assuming you held everything the following day, meaning your put calendar, and you held that one option here, and you decided to sell on the morning opening drive push up right here because things just started getting parabolic, and you just like, okay, now I'm like very happy with my gains. This is $175 up here, and at this point the put calendar might have been down 50%. So maybe $500, maybe $50, or maybe we'll say, $60 you might have been down on that. So 60% on that calendar, up 175 here. So plus 175 which means overall you're still up over $115. Let's just call it $100. Any which way you slice it, right? You're still up $100, and this is if you've done nothing, just decided to hold. And that's if you cut it right here. Deciding to hold the following day, you're up a lot more. And if we take a look at what the 470 call was actually going for, this is where I like to just grab a couple of these, because at the same time, we're talking about this call was going for 7 cents. This is essentially the cost of your hedge, $7. And by holding till Friday, you're up 1,300%. So in other words, $7 turns into $1, putting you up $93. This 7-cent hedge essentially paid for the entire put spread. And when you see the contract going for 7 cents, any person is pretty much not just going to buy one of those. You're going to just tell yourself, maybe I'll just get 3 of these, right? 3 of these turns into essentially $300. And now you're pretty much like, wow, I can't believe that just happened. So the way I like to structure these trades, whenever I'm in some sort of calendar and I'm thinking about there's possibility of that happening, or there's a catalyst coming up, I'll try to look at the strike that I think the market could go if I'm wrong. Or it doesn't have to be the market. This could be anything. It could be Tesla, it could be Apple, it could be Facebook, it could be Nvidia. Any stock in which you're trading, if you're entering some sort of calendar, which would be my suggestion for how you should trade these types of stuff, because you're allowing theta to be on your side. And if the market, as we started with, if the market did not end up going anywhere and it just stayed around here, you would have still made money because the calendar's room for profit. You would have still made money because the calendar's room for profitability was all the way up to here. So anything within this range means you still would have been profitable, but we did expect there to be volatility because we knew there was a catalyst coming up. So guys, if this is new to you, if you have any type of questions, leave them in the comment section below. If you want to learn a little bit more, you can join my Discord. You can ask me the questions there. I try to get back to everybody, as well as share screenshots. The premium Discord is where you can really engage with me a lot more, and you can learn a lot more as I'm sharing this stuff live as the market is open. If I see these types of opportunities popping up, I'm not the type of trader that takes a million trades a day. I'm usually sitting back looking for these types of opportunities. Where I'm personally at in my journey is getting bigger in some of these trades, because I still might see these types of opportunities and maybe only put $800 into the trade, whereas these types of opportunities call for me putting maybe a couple $1,000, $3,000 into the trade, as I know they're very safe and I know I have a lot of room for profitability. So everybody's at a different section of their trading journey. When it comes to iron condors, I won't hesitate to put $15,000, $20,000 in an iron condor when the market calls for it. But whenever I'm taking directional trades, I trade very small because I'm not interested in necessarily putting on too much risk when I'm trading directionally, which is why I look for these types of setups, because I can be taking directional trades, but still put myself in a situation to essentially 3x my money. And it doesn't feel like a lotto. It doesn't seem like I'm gambling. It doesn't seem like I'm putting on too much risk. And I highly suggest you guys start trading this way if you're trying to build up a small account. So if we just jump jump back to the 470, and I'll just leave it on this note. We're talking about 1,000% return, 10x your money, and being able to essentially be super happy that you were wrong, because if you were right, you only would have probably 2 to 3x your money, but by being wrong, you ended up 10xing your money. Imagine that. And at the same time, if the market went nowhere, you wouldn't have lost any money. Thanks for watching, you guys. Hit the subscribe button, hit the like button if you learned something here, and I'll catch you in the next one.